All attendees are in listen-only mode.
Good afternoon, everybody. This is Kirk Kinder of Picket Financial, and we're just going to take a look this month at what the markets are doing and sort of an outlook. If you follow anything in the mainstream media right now, you know the markets are doing very well. And if you listen to the media and take it at heart, there's nothing but blue skies and puppy dogs and cotton candy in the future, and everything looks gravy. Well, there's a couple things you need to realize about me. One, I guess I really tend to try to be a contrarian. So when everybody's positive, I start to get a little negative. When everybody's negative, I try to get a little positive. The second thing is I'm very big on looking at the history. I wasn't a finance major. In fact, I was a history major. So what I do is I pull a lot of my information from historical trends and try to apply those as best as possible to today. So what I want to do today is to take some of the historical trends, some of the things that are going on today, and just give you an idea of kind of what I see. Now, this isn't probably going to be the most positive broadcast I'll do. I'm going to kind of lay things out there. I think there's certainly some things we need to be aware of, but I don't want you to think that I'm casting that there's going to be a huge downturn or anything like that. But I do think that caution is warranted. In fact, I thought about naming this podcast, caution flags ahead or something like that. Anyway, my general theme, the longer term theme that I'm working off of, is that we're going to have lower economic growth going forward. This chart I have used in newsletters and podcasts and webinars in the past. And essentially, it's total U.S. debt as a percentage of our economic activity or gross domestic product. And I'm not going to get into this too much, but we are in an over-indebted situation. And there's a really good book out there called This Time is Different by two economists, Ken Rogoff and Carmen Reinhart. And what they did is they looked at 800 years of history where we had over-indebtedness and a banking crisis. And what they found is the next few years after the crisis, you have subpar economic growth and more frequent recessions. And so far since 2008, they've been pretty spot on. We haven't really gotten past 2.5% economic growth at all. In fact, we've really been more, 1.5 to 2%. We haven't had a recession since 2008, but we've had the subpar growth. So I'm kind of going off of that. That's one of the bigger trends that I work off of. The second thing I'm kind of looking at is something called a secular market. Now, everybody knows that the market, you've heard that expression, the market has returned 10% per year, which over time, that's pretty accurate. But the thing is, the markets don't move in a linear method. What they do is they move in secular, longer term trends where you have periods of flat movements anywhere from 10 to 20 years, and then periods of 10 to 20 years where it goes up drastically. And that's kind of where we've been since 2000. The market has been flat now for 12 years. And if you go back to 1982, from 82 until 2000, the market averaged about 14% per year. So these secular markets, you have secular bulls, you have secular bears. And we've been in a secular bear market since 2000. Now, the good news is if these things go from 10 to 20 years, we have gotten through most of it already. Maybe we're through it, or maybe we have more to go. Now, again, looking historically, I kind of think we have more to go. And the reason I think that, the first reason I should say, is dealing with something called the CAPE, cyclically adjusted price to earnings. What the CAPE is, it's a price to earnings ratio. It can look at a stock or it can look at the market as a whole. So you take the price of a stock or the market in aggregate and you divide it by the earnings. So for a stock, let's say the stock price is currently $20 and they have $2 per earnings for each share. So you just take 20 and divide by 2, so the price to earnings is 10. Well, the cyclically adjusted part, what it does is it takes 10-year earnings. So it goes all the way back from 2012 to 2002 and averages the earnings. What that does is it smooths out the ratio, because earnings are a very volatile number. So it's very difficult in any one year to look at it and say, okay, well, earnings are going to be this year, so this is the price to earnings. This is how you should base market value. You want to smooth that out because of the fluctuation in earnings. They fluctuate so much, and I'll talk a little bit more about that in a little bit. So if you take these smoothed out earnings and you start to look at, what is the true price to earnings of the market right now, you can start to get an idea of what the forward returns are going to be based on current CAPE values. So what am I talking about here? Well, this chart is a very good description. What it does is it takes the CAPE price to earnings and groups it into 5 quintiles. Group 1 is the least expensive or the lowest CAPE values, and Group 5 is the most expensive or the highest CAPE values. So what they've then done is they look at it for each quintile and say, what were the average forward 10-year returns on an annualized basis for each quintile? So for anything with a single digit that fell into Group 1, what did the markets do the next 10 years on average for all of the periods where they started off with single digit CAPE values? And you can see in that situation, it was 11.4% per year going forward. So if you have a CAPE that's, say, 6, 7, 8, 9, you could expect to get close to 11.5% returns over the ensuing 10-year period. Now, unfortunately for us, the current CAPE of the U.S. stock market is close to 24. It's just over 23 right now. That puts us in Group 5, which is the most expensive CAPE quintile. So if history holds, again, who knows what is going forward with history. If history holds, really can only expect about a 2.8% return over the next 10 years in the stock market. So that's really not all that great. But again, history, it doesn't mean it's going to happen going forward, but I'm one of these people that believes that history does rhyme if it doesn't repeat. This next chart kind of looks at the price to earnings, the CAPE values, and then what are the possible drawdowns over the next 3-year period. So again, let's say we are in quintile 5, we're only going to get 2.8% per year. As I mentioned earlier, the stock market doesn't move in a linear pattern. It's not you're going to get 3% per year. Typically what happens is you get lots of volatility, but the overall effect is getting a 10-year return of 2.8%. So what this chart does is says, what could we expect at the current CAPE values over the next 3 years as far as what the market does? What's interesting, the top axis here is the CAPE value. So you go all the way from 5 to 50. It's very expensive. And then here is drawdowns along the y-axis or the vertical axis. You go from 0%. So a 0% means that there was no drawdown. There was either a 0%, that hasn't lost anything, or there's a gain, all the way down to, losing 80, 90% over the ensuing 3 years. You can see whenever you have a single digit price to earnings, the CAPE, there's never been a period where you haven't had a positive return over the next 3 years. So those low CAPE values tend to be good prognosticators for future gains in the market. Even when you're in the low double digits, say 10, 11, 12, most of the periods, the ensuing 3-year periods, were money makers. There's a very few of them where you saw any kind of drawdown over the ensuing 3 years. And those drawdowns that you had were really pretty mild, maybe down 10 to 15% tops. So that's pretty good. The green line here is the average CAPE over time, which is 17. So you can see if you have an average CAPE of 17, you still have numerous periods where you have a positive return over the ensuing 3 years. But you have substantially more periods where the ensuing 3 years had a negative return. Some of them as high as down to 40%. Quite a few in that -10 to -20 period. Our current CAPE, again, being about 22, 23, 24, somewhere right around there. You can see there's still periods where we have positive returns over the ensuing 3 years. But again, we have a lot more of these periods where we hit these high CAPE values with negative returns, some of them having drawdowns as much as 60%. So that, again, I'm not predicting that we're going to have a huge drawdown. I'm not predicting there's going to be a big bear market. You just have to kind of understand, if you're going to invest in stocks, in US stocks, in this kind of environment, despite what the mainstream media is talking about, what are the probabilities? It's all about probabilities. And I base it a lot on historical numbers. So there's a lot of history to show that, hey, you know what? You can't really expect as good of returns here at this high a CAPE as compared to, say, having a CAPE of 12. Another factor that kind of leads me to believe that we are sort of overvalued right now is something called the Q ratio. And what the Q ratio essentially does is it takes data from the Federal Reserve, and ultimately it is a net worth of all the companies. It kind of takes the corporate equity values and the liabilities divided by the net worth of corporations. What a good description is, this is what it would cost to rebuild the companies right now. If, like in housing, if you were going to look at buying an existing home or building one, you'd start to get an idea, is it cheaper to build or is it cheaper to buy existing? Well, with this Q ratio, if it's at 0%, then there's really no difference between rebuilding or buying existing. So right now, based on the arithmetic values, we're about 34% overvalued, meaning that it'd probably be cheaper to rebuild some of these companies than to buy an existing company. Now, this is a high value without a doubt, but we have seen substantially higher at market peaks in the past. For instance, in 2000, at the height of the tech bubble, we were at 153%. So you can see the overvaluation. Even though we're a little bit overvalued right now, it doesn't mean that the markets are going to take a downturn. They could continue on this trajectory for quite a while. Even if you look at 1970, before the 1974 recession, 1937, right as the 1937 recession hit, 1929, and even back to 1920. So these things, at that point, we're looking anywhere about 50% overvalued. So these were market peaks, which did see a large downturn in the markets, but it's still below where we're at today. So you can kind of look at it and say, hey, we have more room to run, or you can say, look, we are kind of overvalued things. You need to kind of take that into consideration. Looking at the Q ratio and the geometric means, we're a little bit more overvalued at 44%. Another factor that kind of leads me to believe that we're in a secular bear still is the CAPE value compared to the dividend yield. Now, this is a very busy chart, and I apologize for that, but essentially this green line is the dividend yield, and then the blue line, what that is the CAPE value. So you can see at other periods where we hit a secular bull market, where we started one in 1982, way back here in 1947, even here in 1942, what we had happening was the dividend yield was getting close to, or even greater than, the CAPE, the price to earnings, the cyclically adjusted price to earnings. Well, right now we have just an enormous deviation between those two. So we've never had a secular bull market begin when the dividend yield and the CAPE values were so far off. Again, history may not repeat this time. Maybe it's different this time, but the disparity leads me to believe that there's going to be some sort of correction in some way to bring us back to a value that will really provide us with a secular bull market going forward, where we'll have 10 or 20 years of great returns. Another factor that kind of leads me to believe we're still sort of overvalued and looking at a secular bear market is something that Warren Buffett looks at. It's his favorite metric. He doesn't look too much at economic factors, but this is one that he does look at. And what this is a total market capitalization of all the stocks in the US stock market divided by our gross national product, the GNP. Now, the GNP is essentially the entire size of our economy. So this not only includes the publicly traded companies that are part of the US stock market, but also small businesses, mom and pop shops, things like that. Well, anytime this value hits 100%, meaning market capitalization is as big as the size of our economy overall, that's usually an overvalued scenario. Even after you hit 80%, typically that is a moderately overpriced value. What you want to see is something 60% or below. 60% is a very good valuation. 40% is a great valuation. You can see the last secular bull market that began in the early 80s, we were at that 40% range. So that was a very good time to buy into the stock market. So right now we've broached the 100% metric. So we're there, 100% market capitalization to GNP. It doesn't mean that we're going to see any kind of imminent downturn. In fact, if you look back to 2000, 1999, 2000, we broached that 100%. We went all the way to 140% in the big tech bubble. And it lasted for several years. It really started to get there probably 98, and it lasted until 2002 when we broke back down below 100%. Even in 2007, we broke it in 2007, and it went all the way until the market started to correct in 2008. So there it lasted a year, but even here it lasted for close to 4 years. So this is another thing that has to make you think, hey, the market's had a good run. It's very richly valued at current rates. What does that mean? Well, another thing that I do look at, another writer, John Hussman. John is typically pretty bearish. He's one of these that's kind of a skeptic. But what he did is he has looked at certain factors, and some of those factors are when you have a CAPE, or the cyclically adjusted price to earnings, is greater than 18, you have a situation where the market is overbought, meaning greater than 7% above its 52-week smoothing average, and also 50% above the previous low in the markets. You have a bullish sentiment, meaning people are bullish compared to bearish, where bulls are greater than 52% and bears are less than 28. Currently, we're at 54 and 22, respectively. And yields on the 10-year Treasury are higher than they were 6 months ago. So if you look at market history, when we have all of those things, that's where all these blue lines show up. So we have 1972, we have 1987, we have 1999, 2007, we had it in 2011, and now we have it today, here in February 2013. Every one of these other situations saw market drops of close to 20%. 2011, the market went down about 18% and then rallied from there, but that's a big correction. Of course, we know 2007 and 1999, we saw what happened there. 87, of course, we had the crash, but it did recover from that quite a bit. And then in 72, it took a couple years, but then eventually 74 hit and we had a really bad bear market. Again, does it mean it's going to happen this time? No. But again, when you're investing, you have to kind of look at what's the probability that investing today is going to provide me with the kind of return that I should be compensated for. When you step into the stock market, you are taking additional risk. Is that risk going to pay off? Are you going to be rewarded handsomely for that? And again, I look at it historically in order to get that decision. So when you start to look at things, I'm cautious. I'm very cautious right now. Last thing I want to talk about on the secular level, the longer term, is just giving you kind of a graph of where secular bear markets end and secular bull markets begin. The blue is the current secular bear market, and then the others, we have the 1901 and 1920 secular bear, 1966 to 81 secular bear, and 37 to 41 secular bear. And then, of course, the Great Depression here, 29 to 32. So what this shows you is what were the CAPE values, the P&E, smooth out over 10 years. Where did they kind of hit before they bounced into a secular bull market? And you can see almost every one of them reached sort of the below 10. They hit 10 or below, and then you saw a very good secular bull market where you had years of positive gains going forward. With the blue line here showing ours, we're still kind of in that range where you're in a secular bear market, and the bull market just doesn't exist. Even at the bottom in 2009, we really only got to about 13. So we never really got to a solid low. Now, it doesn't mean that, maybe that was it. Maybe 13 was it, and we hit that secular low, and now we're in a secular bull market, and that's why the market's done very well. And if so, we could expect maybe another 10 years of great returns. That is possible, absolutely. But if you look at history, we probably didn't get there. And, unless this time is different, and that's a very dangerous phase to say in investing, this time is different. I kind of think we might have a little bit more of a correction to get us back to really good long-term trends. Now, with secular markets, you still have within those cyclical markets. You have cyclical bears and cyclical bulls. So you have ups and downs in secular trends. If a secular trend can last 20 years, you're going to have several bull and bear markets within there. And this kind of gives me a little bit more of a caution too, because since the low in 2009, we've gone almost 4 years now since the bottom. And if you look at history, the average cyclical bull market lasts about 3.8 years. So we're right at that average. Again, it doesn't mean that there's going to be a downturn. If you look at 1990, we went more than 9 years in a cyclical trend where we didn't have a bear market. Same with 1949, we hit 7 years. So it is possible to go for several years without having any kind of cyclical bear market. But again, we're kind of at that average, so you have to start to raise the radar a little bit and take note. A couple other things that just have me sort of concerned. If you look at earnings, they're still doing well, but the revenue numbers aren't doing quite as well as the earnings. So sales are slowing while earnings are kind of maintaining. It's a trend to watch. Eventually, if sales continue to drop, your earnings are going to follow. You can't continue to squeeze out higher profits when your top line revenues are dropping. And I talked about earlier how you never wanted to use earnings in any 1 year or future earnings as a predictor for future stock market performance. You wanted to use the CAPE where it averages it over 10 years. And the reason is earnings are very volatile and they mean revert. And what does that mean? Well, these numbers tend to revert back to the averages, and they're very volatile with that. And the reason I think that's very important in this situation is right now, corporate profits as a percentage of the gross domestic product or the size of the economy is at all-time highs. This chart shows you the corporate profits in blue. And you have to look along the left axis here to see what the profit margin is divided by the gross domestic product. So this chart goes back to 1947, and you can see the best really we ever did, as soon as we got around 8% profit margin relative to GDP, you started to see a pullback in profit margins. Well, right now we're over 10%. This is a historical high. We've never been this high before. So that should kind of give us cause for concern. Here in 2007, we breached at 8% and got almost 8.5% before it started to make a downturn, and earnings reverted back to the average. Well, what this red line here is, it's the subsequent 5-year growth in profits at each profit margin currently. So you take the blue wherever it is, and then you see what were the 5-year earnings going forward at that point. So this sort of trails, and it also, you have to look at the right axis here to get that idea, and it's also inverted. So you can see earnings growth is actually on the bottom and earnings shrinkage is at the top. So for instance, when here in 1999, profit margins were almost 8%, hitting that top range that we usually see. Well, at that point, what you saw going forward as far as earnings was, earnings growth was about, you could say maybe it was pretty flat, about negative 1%. So at that point where you're hitting here, earnings growth over the next 5 years dropped about 1%. Now here, where earnings as a profit margin relative to GDP was about 5%, which is kind of on the historical low mark, the forward 5-year growth was actually very good. So earnings improved by 13% over the next 5 years. So what can you take away? Well, when we have profit margins that are around 5% of GDP, you usually have pretty good growth in profits going forward. Whenever profits are around that 8% or above, profit growth going forward is usually negative or very low. So again, you wouldn't want to use current values right now because probabilities are such that we're going to see, or if history holds, we're going to see some sort of low or negative earnings growth over the ensuing 5 years. Some other things to watch, despite all the great news on the mainstream media, some of the leading indicators I watch for the economy are kind of real iffy. One of them is manufacturing. Manufacturing, it's still growing. It's about 2% per year, but you can kind of see we have a downtrend going back from 2010. If the downtrend continues and it hits zero, that's usually a telltale sign of recession. It's not there yet, and this thing could bounce up and start to increase. Who knows it, but it's something to watch. Same with retail sales. Right now, they have kind of steadied out at about 3% growth, which isn't too bad, but there is a downward trend. And again, once you sort of hit that 0% growth in retail sales, typically that's when a recession starts. Same with industrial production. This is another leading indicator. And again, it's at about 2% growth, but it does have a downtrend. You have to watch that. If it violates that 0% growth, usually we tend to fall into recession. In this chart, it's just interesting to me that what it shows is global manufacturing PMI compared to the world stock market. And you can see from 09, there's a pretty tight correlation between the two. When manufacturing is doing well, so does the stock market. Well, recently we've had kind of a disconnect. Global manufacturing has been slowing, whereas the market's still continuing to do well. One of these two is right. So either the stock markets are right and global manufacturing is going to rise to that level, or global manufacturing is correct and the market's probably going to come back to meet that. That's if correlations hold. Now again, in intermediate term, I'm still very bullish. A lot of the factors I look at, 200-day moving average, relative strength indicators, moving averages, converging, diverging lines, everything like that looks pretty good. Again, nobody knows what's going to happen in the near term. I'm just trying to point out that despite all the bullishness in the media and on CNBC, everything like that, you really have to start to wonder, where are we at in the cycle? Typically, when you see so much bullishness, it kind of raises the flag, and you should be cautious. So what I've been seeing is there are a lot of people who have been in CDs for a while are starting to come back into the market. They're starting to ask me questions about it. That sort of raises the flag for me that, hey, maybe we're in the tail end of this uptrend. But intermediate term, things still look okay. And again, even with overvaluations, they can continue for years. I remember back in 1996, Alan Greenspan said there was irrational exuberance in the markets, yet the market continued for 4 more years before we had any kind of correction. In fact, 4 of the best years the stock market had with the tech bubble. Shorter term, there are some other factors that kind of have me concerned. So, longer term, I still think we're overvalued. In the intermediate, things look okay. Short term, I think we're due for a pullback, honestly. I really do. It doesn't mean it's going to happen. But again, there are certain factors that I look at that sort of make me cautious. Now, it's interesting. Some of these factors, what they do is they look at people who are bullish and people who are bearish. You would think that when everybody is bullish, that would be great for the stock market. When everybody's pumped up, when everybody thinks it's going to do well, you think it would continue because everybody's buying. But the reality is, when everybody is bullish, that's when you want to be bearish. And when everybody's bearish and wants to get out, that's when you should be bullish. What this chart shows, it comes out from Ridex, and it looks at the mutual funds that the people are investing in where they're long the market. They think it's going to go up. and mutual funds that are short the market. So Ridex has both those kind of funds, and they just look at the discrepancy between who's bullish and who's bearish. The green lines here represent bearishness. So whenever we hit kind of lows here, when people were very bearish on the market, you typically had an upturn in the markets, which is interesting. Right now, where this bullish factor is kind of hitting the peak that we've seen before. And when you've seen these peaks, you've seen some pullbacks in the market. Now, these aren't huge pullbacks. These aren't market crashes by any stretch of the imagination, but they are pullbacks. So they're showing that people are just a little bit too bullish. Now, another short-term factor that I look at is insider sales. Now, this one, basically, when people are bullish, when insiders, meaning corporate executives, people on the corporate board, the CEO, the CFO, people who have to disclose their holdings in the company, when they're bullish and they're buying their company stock, you want to be buying the stock market. When they're selling, you want to be selling. So up here, what you have is corporate buying above the normal trends. And down here, these are the lows where corporates, insiders are selling. You notice when corporate insiders are selling, we typically, so oftentimes, and it does lag here, you can see a lag, but oftentimes we have kind of a pullback. It's usually not a good sign when people who are inside the company are selling stock. And now the thing is, people inside the company are always going to be selling stock. There's always stock options that are being granted. There's always reason to sell for diversification. You're always going to have more sells than you have buys. But if that ratio, where you get the point here, people were buying like crazy, and what happened to the stock market? It went up considerably. So if you see points where they're really buying, they're putting their own money into their company stock, that's usually a good sign that, hey, we think the market's going to go up. Here's another good one. Right now, we have about 9.2 sales for every buy, which is at the high end. So again, they're kind of, corporate insiders are saying, we're selling, we're getting out as much as we can. I think it was in the news just recently, Eric Schmidt, the CEO of Google, who hasn't really sold any shares at all, has unloaded a substantial portion just recently as Google hit its all-time high. You have to wonder why he didn't sell back in 2007. He held on. He's held on all throughout, but now he's selling a large portion. And part of that could be diversification. Certainly it could be. But he's had such a large percentage of his net worth in Google for years. Why would he pick now to sell? I don't know. That's only one instance, but what you look at is a general trend. Now here we're looking at individual investors according to the American Association of Individual Investors. Again, when you hit extremes, as noted by the red here, with people being bullish, typically what you find is some sort of pullback shortly thereafter. Again, not a market crash, but some sort of pullback. And again, these are short-term factors we're looking at here. When you get the green, when you have people that are when the people are really bearish, you typically have some sort of upturn. So right now, again, we're a very bullish factor. Doesn't mean there's going to be a downturn, but it should raise your caution flags. Same with people who write financial newsletters. So this is put out by Holbert Financial Digest. They look at people who write all these financial digest and financial newsletters that they sell. Anytime you give it above 76% of them are bullish, that's typically kind of a peak. You can see it's denoted here by the little red dots. We hit these, and you can kind of see when bullishness gets to be a peak, we do have some sort of pullback in the markets. Again, not a crash in all instances, but a pullback. This is volatility as measured by the VIX, or the Volatility Index. Again, the lower the volatility, the more complacent investors are. And right now, the Volatility Index is at lows last seen in 2007. And in fact, it hit single digits just a couple weeks ago. It hit 9. It's back up to 12. But there's very low volatility, which means everybody is very complacent. Typically, when you have a lot of complacency in the markets, you tend to see some sort of pullback. Again, not a crash, but a pullback. The last thing is there's a lot of individual investors returning to the markets now. Their history shows that when individual investors sell, that's usually a good time to buy, and the converse is also true. So we do have a large inflow of people coming into the market that sort of raises the caution flag for me. Okay, so that's just talking a little bit about the markets. Again, the last part is just short-term factors, which typically lead to short-term movements up or down. Again, not crashes, not big bear markets, but you could see, sizable anywhere from 5 to 15% moves on these short-term factors alone. And again, long-term factors, I do think we still have some rough sledding ahead of us. But the good thing is, if we still are in a secular bear, at least we have 12 years into it. So maybe at worst case scenario, we'd have another 8 years. Maybe we have another one, maybe another two. Who knows? Or maybe we did hit the bottom in 2008 and now we're in a longer term secular bull. Only history will tell. Intermediate trends still look pretty good. So, I mean, I'm just trying to give people sort of an idea of what they can expect as you see all of the great news in the media and how everything's just great. You need to start to look and take note of some of the factors that typically lead to some sort of corrections. Don't be as bullish as everybody else. That's my advice. The last thing I want to talk about, I get this question a lot. I've been invested in long-term bonds off and on here the past 5 years, and I still like them. People think I'm absolutely crazy that I like long-term treasuries. And it's not that I like long-term treasuries for the next 20 or 30 years. I don't. But I still think that over the short term, long-term treasuries might do very well only because America, while it's still in a bad position with its debt, it's in a better position than a lot of other countries. And I think money will still continue to run here when there's fear in other markets. But the other thing is, again, I look at history, and history does show that long-term treasuries could do very well, even though we've had a great run with treasuries over the past 20 years, 30 years. So what this chart looks at is the last panic attacks caused by over-indebted economies. These aren't caused by lack of liquidity, but just over-indebtedness. So it looks at Japan from 89 and the US from 1873, 1929, and 2008. And what you can see is the periods from when the crisis hits until it ends, long-term treasuries tend to do very well for 20 years or more. And if you look at 2008, we're only in year 5 here. So if history holds, we could have a few more years where long-term treasuries tend to do pretty well. And this chart kind of gives you an idea based on the last 4 periods where we had over-indebted economies. The average low level of interest rates after the panic on long-term government bonds usually reached about 2%. Japan actually hit 1.5%, but in America in 1873 and 29, we hit 2%. So right now we're at 3%. So we could see rates continue to go down until we hit about 2%, which would be about a 30% increase in the value of the underlying bonds. The average number of years after the panic to the lowest level in interest rates on average for these periods has been 13.7 years. And again, we're in year 5. So we could have a few more years before we really see rates bottom out. The average level of interest rates 20 years after the panic, only 2.5%. So that's still below the current 3% level. So we could, even for the next 15 years, still see rates kind of where they're at right now if history sort of holds. The change from the low level of interest rates to 20-year, just 0.5%. So while you may hate long-term bonds over the next 15, 20 years, and I completely agree, especially the way the government's adding debt, over the near term, maybe for the next 4 or 5 years, it could surprise everybody. The other thing is everybody's calling for the bond bubble to burst. Everyone's saying this thing is over. There's nobody, hardly anybody, likes long-term bonds. There's very few people that do. So again, going back to how when everybody's bullish, you should be bearish. Looking at this, maybe long-term bonds are going to do well. If everybody liked long-term bonds, then I'd probably be taking the opposite side. Okay, so let's just take a look and see if we have any questions. Okay, here's a good question. Does the fact that the Fed is printing money change any of your thesis? Absolutely, absolutely. In fact, I would argue that the Fed's monetary easing has kept this market elevated longer than it probably should have. It's not really where the fundamentals would be, but the fact that so much money is coming into the markets, it's got to go somewhere, and it has gone to the stock market. And in fact, I don't have the chart readily available, but I could show you that every time the Fed has implemented a quantitative easing program, the market has responded by going up. And every time the QE program has ended, the market deflates. So certainly everything I've shown you as far as valuations could be a moot point. Maybe the Fed just continues to put money in there and the market continues just to go higher. A great example of that is Zimbabwe. Zimbabwe's central bank printed so much money that their currency became worthless. Their stock market on a nominal basis was the best performing stock market. It just went up like crazy. But the problem is, despite the rise in the stock market, if you cashed out your stocks, you'd barely be able to buy a loaf of bread. That's how bad the currency was. So if the Fed continues to just print, you could see everything continue to go up in the stock market. The only thing that makes me think that that's not the case right now is gold has been a very good correlator with the Fed printing money. Again, I don't have the chart readily available, but every time the Fed has been printing money, gold has gone up. And right now, despite the Fed printing, gold is going down. Gold's losing value. So, I don't think that the Fed will be able to control this forever. It's impossible. If that were the case, the Fed could just print forever and we all become fabulously wealthy and we'd never have anything but blue skies and puppy dogs and cotton candy. But eventually, market manipulation can only go so far. So you have to look at the underlying values because at some point reality sets in. And if you're not positioned for reality, you're going to have a nightmare. So that looks like that's the only question. And it was a great question. If you have any questions, please let me know. You can email me or call me. I'd also like you to visit my website, picketfencefinancial.com, or my blog, savingyouFromWallStreet.com. There you can sign up for my monthly newsletter, and you can also, with that, find out about any kind of upcoming webinar or podcast or any other kind of information that I put out there. So if you have any questions, again, please let me know, and I'd like to thank you for taking the time to stop in and watch this. So have a good day.